I request all the exhibitors to come down because we will be discussing about funding and investment opportunities. This is your one-time chance. We have a very intense guest list that's lined up for the session that we are conducting right now. Funding and investment opportunities. I'm sure nobody wants to miss this. So I request all the exhibitors to come down and be seated. If you're looking for funding and investment opportunities, this is a great platform. Well, ladies and gentlemen, requesting all the exhibitors to come down for this session. We have a panel discussion and it's going to be about funding and investment opportunities. If you're keen to know about all of this, then all the exhibitors are invited to be seated on the round tables. All the exhibitors are invited. I would request all of you to kindly come down and be seated. We are going to have a panel discussion and the session is going to be about funding and investment opportunities. Well, we will wait for another minute. Well, let me remind you again, this is a session about funding and investment opportunities. It's a great platform for all of you. So I request everybody to join this session. This is going to be a panel discussion. Well, I think most of them are here, so let's get this continued. Well, if there are any more exhibitors, we would like to invite all of you to join us for the funding and investment opportunities. This is a panel discussion and it's a great opportunity to all of you. So I request all of you to kindly come down and be seated for the funding and investment opportunities panel discussion session that we're going to conduct right now. Okay, let's get this started. A very good evening to all of you once again from India First Tech Startup 2022 Conclave and Awards. This is a moment of great joy and immense pleasure. We have distinguished guest list for this discussion on startup funding and investment opportunities. First and foremost, I would like to welcome Shri SudhakaranSrambikal, CEO and co-founder QuGatesTechnologies and the moderator for this discussion. Can we give it up for him with a big round of applause, everyone? Thank you, sir, for joining us. Please be seated. Now, let me take the honor and invite Commander Navneet Kaushik, Scientist F, Technology Development Board, DST, Government of India. Can we give it up for him with a big round of applause? Let the applause keep coming in. Thank you, sir. Kindly be seated. Next, I would like to call upon VikaramRamasubramanian, Partner, Inflection Point Ventures, IPV. Thank you very much for joining, sir. Can we give him a big round of applause? Come on, we can do better than this. Lovely. Next, may I invite Ashwin Raguraman, co-founder and partner, Bharat Innovation Fund. Thank you very much for joining us, sir. Next, I would like to invite Deepak Agrawal, Principal, Dexter Capital Advisors. Come on, let the applauses keep flowing in. May I next invite Dinesh Goel, partner, SianaCapital. Well, looks like Dinesh Goel is not around, so we will be asking Varun, Mr. Varun, to please join us from SianaCapital. Thank you, sir. Please have a seat. Lastly, I would like to invite Siddhartha Anand, the Vice President at Karnataka Digital Economy Mission, to occupy the distinguished chairs for the discussion. Welcome, sir. Can we have a big round of applause for the entire panel? Come on, ladies and gentlemen. Thank you very much. So the stage is open for the panel discussion. So if you want to discuss anything, they're open for it and they're all here to help you. I hope you make the most out of it.
Thank you. Thanks for that wonderful introduction. I still see a lot of chairs empty. May I have all those exhibitors be here because we're going to distribute a lot of paychecks here. So if you want to know as to how you need to get your hands onto the check, request you, please come and occupy these chairs. So before we start, let me set the ground rules for the panel. We have 3 razors, Hichlin's razor, a Hanlon's razor, and an Oscom's razor. And you must be wondering what Greek and Latin am I talking about when it comes to investment and funding. So the 3 rules are, as per the Hichlin's razor, whatever you state here without evidence will be dismissed without evidence. The second Hanlon's razor states that what can be explained through mere reasoning or stupidity, there'll be no attribution whatsoever done to malice or conspiracy. And the final Oscom's razor is, the truth can be simply explained. If somebody is explaining something very complex, then we'll take it for granted that it's untrue. So if these are the ground rules, there are some questions that we're going to ask. How do we get the money? Whom do you give the money to? When do you give the money? And why do you give the money? What do you expect in return? So these are simple questions that we're going to ask. There's nothing complex about it. And I'm pretty sure these are the answers that you want to know. So we've got something over 45 minutes to conduct this session. And in 30 minutes, we'll finish our round. And we'll open it for 15 minutes to the audience to ask their what, where, when, and why. So game? If you're game, please put your hands together. Let's start. So my first question is to VikaramRamasubramanian. He's partner, Inflection Point Ventures. So the first question is, what are the milestones that a startup should target? What are the risks involved in implementation of idea from a venture capitalist perspective?
Sorry. Thanks for the question. So, whilst each startup is different, the journey is different, the product that they're trying to solve is going to be different, right? There are certain key common themes that come out in terms of the milestones and the risks that a startup should kind of address. So probably I'll just take or summarize it into 8 points. The first is there should be a market fit for the product, and the product must be timed appropriately. What do I mean by this? More often than not, there are startups which have a solution and then go in search of a problem. It should be the other way around, where you have a clear definition of the problem, you understand the problem well, and you must design the solution for it. That is when the customers are going to accept it. That leads to the next point. You shouldn't ignore the customer. You should design the solution for the customer, for them to use it, right? The third, again, is from the customer's perspective, that it must be user-friendly, it must be easy to use, easy to adopt, and that is what will lead to scale. Now, this again leads to other economic points, right? That the product must have a price point which is acceptable to the customer so that they can adopt it and use it, which is going to lead to your scale. Now, that is on the customer side. From the business point of view, if the product does not have good unit economics, you're not going to sustain for long, right? And if you're not going to sustain for long, you're not going to be able to expand globally. And therefore, your scalability, your expansion points become a challenge. Now, all this said are from the various stakeholders. Now, when you look at the market, how are you going to be addressing? In my view, one of the key definitions of a startup is that it must be agile, nimble, and must be able to adapt to the market dynamics and conditions, right? So therefore, it comes to the other critical point that you must have a relevant and appropriate business model, which means that the startup, the founders must have thought through what are they going to solve, how are they going to solve, what is the pricing, what is the benefit to the customer, what is the benefit to the supplier, who are the competitors, what are the risks involved. You must think through all of this, put it together, and build that model. Now, this leads to the last 2 points. One is you cannot ignore competition. More often than not, there is an element of overconfidence, if I were to use that word, that what your solution that you have, what product you have is very good and you're going to succeed. You must keep an eye on competition. If you don't and you get outcompeted, it's a risk that you can't solve so easily. And last but not least, the product, the solution must be compliant. It must address all the rules, regulations, and the regulatory aspects that are imposed on every entity. So I would kind of summarize it into these 7 or 8 points as what are the various milestones or the various risks that a startup must keep in mind to grow and to succeed. If these are addressed, there are enough and more examples today that you have got 100 unicorns today, and all of them would have ticked these boxes in one way or the other. Hope that answers the question.
So he's given 8 points as to how you can take money from his wallet. By the way, he's funded more than 100 startups. So I've given you 8 reasons to convince him. So next time you're in front of him, just take note that these 8 points are adhered to. So we have a second question to you, and that is traditional human capital factors play a very important role. So vis-a-vis a pedigree, coming from a premier institute or having a relevant industry experience, which of the factors play more while you take that decision to spend your money?
Another interesting question though. If I were to answer, you would also see in most of the startup pitches that we have received, right? You would see a lot of the founders who have achieved and gone on to build large companies have dropped out from their various education institutions. So to answer the question saying, is being from a premier institute necessary? The answer is 50-50, right? Is work experience essential? Yes, it again goes from case to case. But again, I'd go back to my essence of the previous question saying the attributes that you need to look for. One is the vision. As I said, this goes back and connects to my previous statement saying you need to have a solution which is built for a problem that is faced by many people, quite frequently faced by people, and it must have an impact. So he must have that vision and that clarity of what he's solving. Second is the ability to execute. That is to go after the vision and execute it. The third is as you grow, you might start off as a single founder. You might then get a co-founder on. You're going to build your team. You're going to grow in scale, right? So people factor of managing people becomes essential. So the leadership attribute needs to be honed. And for that, you need to have a mind to experiment and solve problems. Now, this is where I would pause and say, if you're from a premier institute, let's take as a case in point an IIT or an IIM, these come through the experience that you go through in those 1 or 2 years of education, and you try to experiment, you try to solve more problems. And that's where you would see statistically more IIT, IIM grads or premier institute grads tend to be better problem solvers and better at experimentation. The other thing is passion, that you cannot define through education or through statistics. You have to kind of stick it through, and the pandemic has been a great example of those founders who have had the vision, who have had the clarity, who have had the ability to execute and stick through it, right? And they who come with that passion often succeed. So again, I would kind of put it in these 5-6 points to say, is it only the institutions and the experience? I would rather say it is more these attributes, or any founder who displays these attributes would have a higher degree of success.
So passion more than pedigree, that's what you said. But yes, pedigree does matter and industry experience matters more. So he's not given a very clear-cut answer. If you tick the right boxes, if you have the passion, if you can convince him with the right answers, his money is there for you. So let's now get to Commander Navneet Kaushik. He has a lot of money, and he has a lot of money from the government of India to give you, right? But then we have a lot of questions for him, because not too many of us get the government funds for free. The government is scared of you, and you're scared of the government. So let's ask some very important questions to him. So when we talk about getting money from the government, often the project is of national security importance or of national importance and demands funds in excess of what an individual or a private venture capitalist can fund. To that extent, may I ask you what policy changes you expect or suggest to central or state government to attract more benefits for startups?
Hi, good evening, ladies and gentlemen. Thank you for having me here. And I think the first question, the first statement which you made, I'm just trying to say that you don't have to be scared of the government anymore. I'm here to answer your questions, and I can have a discussion after this. Just to be, just to talk about my organization before I answer that question, because that will put the thing in context. So I'm from Technology Development Board. So the organization has been in existence from last 25 years. And within our ambit, we have the first vaccine which was made in India, the first electric car which was made in India, the first indigenous car, Tata Indica, was funded by us. The first liver transplant hospital was funded by us. The first RT-PCR kit was funded by us. And there are lots of firsts which we do. Here, I'll slightly differ from you, because being the government, we can take that chance. So we have taken chances on the technology. So when I talk about first vaccine, I'm sure any venture fund will find it very difficult to fund an idea which you don't even know what's going to happen, but the government can. So we have done in the biotech sector, we have done we have a huge impact. Now coming back to the question which was there, that a lot of times you need capital which is beyond an individual's capacity. So that is where something that I can talk about. There's a lot of government push which is coming in. There's startups which are being supported by nearly every ministry, every state. Yes, at the seed support, it is lesser. You will have probably 1 crore or 2. But when it comes to commercialization, for TDP, we have no, we have no limit per se. As of now, our guidelines say up to 50% of the project cost can be supported by us. We generally do not give grants. We give a soft loan. The soft loan is at 5% simple interest for a period of at least 6 to 7 years, which is lower than your inflation. Right. But more importantly, the more important part for us is the technology. So our evaluation of technology is much more important, much more in-depth. And once we have, cleared a project, I think Adverb is right here, for which we cleared around 5 crores, but we issued a letter of intent, but after that, they have raised around 350 crores as of today. So there's a lot of, deep tech which we support. SaaS, generally no, but in case there's something very interesting, we do go by. And coming back to the point of, the funding, we have funded up from 7.5 lakhs to 250 crores for a project. Now, each project will have its own requirements. Now, every organization has to change with time, so we are also trying to work on new policies for the startups. As of today, 50% of the project cost has to be got from the startup, right? 50% we fund, 50% has to come from the startup. So we are looking at probably trying to increase that number from our side, maybe take it around 60 to 70%. But then we are not going to fund entirely. We are not going to get into grants, because simple thing is there has to be some skin in the game. Unless you're invested in your idea, unless there's some kind of financial involvement from the startup for commercialization, it does not work. For R&D, yes. For R&D, there's Department of Science and Technology. There are various programs which are being run by MIT. So there's a lot of support there. But for commercialization, I think TDB happens to be the unique organization which can support.
Thank you very much, sir, for that deep insight. So we are not scared now. You made us feel slightly better. Coming to the second question, yes, of course, commercialization, we do understand you give grants. But when you talk about developing critical technology specifically for the defense sector, it often entails, again, huge funding for the ideas to translate into reality. How does the government framework help such startup? You talked about MeitY, you talked about DST funding. What is the magnitude of that funding? How much does it get to? And most often than not, most of this scale goes into tens of crores, if not hundreds. So how does the government framework help such startups? What are the various avenues and opportunities for incubating such startups towards developing a basic MVP?
See, if you really ask me, for the defense startup, there is a TDF, Technology Development Fund from DRDO, where they're taking, the suggestions of what projects you can do. That is one part. Then there's a PPP models which are being talked about now, where the public-private partnership will come into play, where the government can put a part of it, and then the companies do come in. But individually, for government to fund a startup for hundreds of crores without any intervention from any public, because at the end of it, this is something which I heard from one of the companies. The government can make a cake, but it is the private sector which has to garnish it and sell it. Because unless you sell it, it doesn't work. And if you only have a customer, let's say only defense sector of India, then probably the value creation in that is not going to be too huge, because you have a captive market. So you have to compete at the end, and competition can only come from the private sector.
Thank you very much, sir. That takes me to the next panelist for the day, Ashwin Raguraman. Welcome, sir. He's co-founder and partner of Bharat Innovation Fund. And here goes my first question. How do the risks compare with potential rewards, both from the VC side and from the startup side?
Am I audible?
Yes, yes.
Yeah, thank you. First, thanks for having me here. Quick introduction. We as a fund invest in two types of startups: early stage deep tech startups that are globally competitive, and at the other end, we also invest. Am I audible now? Thank you. So just a quick intro. We are an early stage venture capital fund. We invest in two sides or two types of startups. One set of startups are globally competitive deep tech startups that originate from India, so high on innovation. And we invest in anything from a pre-series A to a series B level. The other set are startups who are building for Bharat, so enabling access to lower income and tier 2, tier 3 consumers to financial products, education, healthcare, and so on. Having said that, Mr. Sudhakaran, I think at the beginning you set some ground rules, which were very beautifully articulated. I'll add a fourth ground rule. I'll answer your question with just a maximum of 3 points, which is sort of a standard, right? So let me answer this one on risk with 3 sort of thoughts on the whole risk piece. I think the first point I have is that entrepreneurs think about anything as an opportunity. Their startup and a market is an opportunity. And we as investors have somehow been trained to think about a market or a startup by looking at the risks that are associated with it. And as a result, there is this little bit of mental divergence when entrepreneurs interact with investors. And I think it's very important that startup founders are cognizant that when we ask them questions and sort of rhetorically try to disprove statements they make, it is with the view of trying to identify the risks. And having said that, I also think that we and our friends in the industry need to get a little bit more opportunity focused rather than just risk focused, and that will help us take bigger, riskier bets. The second part is, as you pointed out, risks and rewards are sort of proportionate. And if I were to think of the stages at which different types of investors invest, we as VC funds invest far earlier in the game and in the startup's evolution, and we go in typically thinking that only a very small percentage of our investments will be successful. We also raise money from investors before we deploy in startups on a promise that we will give them back some returns. And as a result, because our percentage of successes are very low, we need our few successes to be extremely successful to make up for the ones that fail. And therefore, we're always looking at 10x, 10 times what we invested as a return, 15 times, 20 times, and even in some cases, higher multiples. Whereas if you think about the later stage private equity funds who come in, when a startup is a lot more established and even in some cases into big businesses, they look at 3 times, 4 times of what they invested as a very, very good outcome for them. So it's a little bit of how much risk you take at the startup, how early you go in. You expect commensurate returns, and every time we invest, we want that 10x to 15x return at the least, so that it will make up for the ones that don't carry that risk. The third and last point I want to make on risk is one thing that I've observed over time, and this is the second fund I'm running. So I've been in this space for over a decade. And I remember the first company we invested in, a company called Mitra Biotech, Bangalore-based, went international. In this and in many other cases, we have seen that you may mitigate for as many risks that you can think of. And still what will hit you as an entrepreneur is a risk that, or something that you never ever thought of or even imagined. In the case of Mitra, which I brought up, they were in the drug discovery space and doing some work with mice. And they had labs, which was at the Kiran Mazumdar Shaw Center in Bangalore. And they were extremely successful when they tested their product on mice originating from India. And the minute they had to change because they were thinking of US markets and tested their product on European mice, just the nature of the European mice made their product unsuccessful. They had to do a lot more work before it could actually work on that, and then eventually on mice which were in the US. We didn't even imagine that a mouse in the US versus a mouse in Europe, a mouse in India, and I mean, there were many other risks we thought of, but certainly not this one. And with time, I've realized that you may think of many risks, mitigate, and we should do that as entrepreneurs and investors, but sometimes what will hit you out of the bat is something you've never imagined. And therefore, that goes back to a point which one of my other panelists raised. Nimbleness becomes important, because when you're hit with that one thing, and you will be time and time again, how nimble you are to react to that situation as an entrepreneur is what will decide whether you succeed or whether you fail.
They said men are from Mars and women are from Venus. I only thought there are only 2 of a kind, but you said that there is no one solution for one Earth. A solution that works for India doesn't work for Europe. So that's the take that you will have to. There are risks at every step, but there are opportunities too. But yes, when you look at from the venture capitalist side, money is very hard to earn. It's very hard to come by. So you will have to earn it by convincing. by convincing, by presenting the solutions that you have for the opportunities. So that takes me to the second question. And the second question is, because you have innovation in your fund's name, it's a relevant question. We talk about indigenization, Atmanirbhar Bharat. That's the buzzword of the day. But there is no indigenization without research, right? And research and development is very resource intensive. But most venture capitalists talk about revenue, how fast can you get the revenue? Researchers don't get revenue. Researchers only take you towards revenue. So the question is, invention and innovation need solid research at its foundation. R&D is very resource and time intensive. How open are investors to invest in core R&D that can bring in real disruptive technologies, and how do you go about that?
I think the short answer to that is investors are not open at all. And there are very few investors, I think 3 of us are sitting here, who invest in what we call deep tech, deep science startups, which require a lot of time and gestation before they can demonstrate returns, right? And when I say 3 of us, I mean 3 private investors. Of course, the government, and I'll come to that, is a different, there's a different piece there, or role they have to play. The reason is simple. Capital is like water, and it flows to that point where it gives you the highest returns quickly. And the minute you have high gestation projects or startups, very often you have other options which give you returns faster than some of these deep tech, deep science startups that exist. And as a result, you see that a lot of investors, especially in India, tend to stay away from such startups. Having said that, the minute some of these startups reach a point or an inflection point where they can demonstrate that there is a market that is absorbing their products, so what he referred to as product market fit, the same investors who were a little bit skeptical are the ones who are much easier to convince than otherwise, because they now know that you've got a very solid moat, which some of the other startups that they invest in may not have. So what's the challenge here? It's that initial part where you're trying to build and research and develop to a point where you have a product which is ready for market. And because there are such few funds that invest at that stage, what is very important there is the role of the government. And I know that DST and some of the others, DBT, have been playing a stellar role in funding such startups, especially at the R&D stage, and helping them reach a point where at least some of us who are a little bit more inclined can support them, and then eventually the entire set of investors can support them. But having said that, given the number of startups that are mushrooming with a whole lot of R&D in focus, I think these, the effort from the government, who has to support areas where private capital is not going, I think that's the role of government and DST. I think that has to be scaled up. And scaled up not just at the base of funnel level where they operate, which is early R&D, but even the successful ones, especially in areas like biotech and a few other areas which take even longer, as the startups evolve and continue to develop their products, funding at even later stages through programs which come from governments or corporate grants could be extremely helpful for these startups to also attract private capital.
So the truth is out. Innovation, invention doesn't get the deserved funds. Where do we look for? There is a gap. That's the challenge that this country has to solve if we need to really stand on our feet and claim to indigenize technologies. So that's one question for President ICRA to note, to take it to places, and to find a solution sooner or later. Thank you, sir. Let me get back to the panel. And next we have Deepak Agrawal, Principal, Dexter Capital Advisors. And sir, the first question is, what are the points you check while investing in any new ideas? What is the turnover point you keep in mind to achieve break-even point of your investment?
Hi. Can you guys hear me? Hi, so this is Deepak here. I'm from Dexter Capital. Dexter has two wings. One is Dexter Angel, where we invest early stage checks, which is anything from 50K to about 500K in early stage startups. Sector agnostic, come across different stages, different places. I've invested in 13 startups and also very actively looking at building up that portfolio. Also, we have Dexter Capital, where we do investment banking, advisory services, where we help startup in raising capital, anything from a Series A to Series D. So, we've been talking about the, specifically Dexter Angel today. So, to the question, there is no specific revenue threshold that Dexter Angel looks at. We have done startups which were pre-revenue as well. There are startups where we have done where the startup has reached the stage of 100K to 500K kind of an ARR or an MRR as well. So it's different for different stages, different startups. Sometimes the entrepreneur has been passionate enough for us to come in at the early stage, and that's where we have come in. There are places where we have waited for certain startups to reach to a certain scale, and then we have engaged. So it's different in different contexts. At different places, we have also come in at almost just at the Excel sheets as well, where the product itself wasn't been kind of built. So it's across. It's depends upon startup to startup, entrepreneur to entrepreneur, and that's where our kind of a thesis lies. On the second question, specifically on the breaking point, we don't really insist on specifically breaking even, but definitely the seeing the current scenario, breaking even becomes very, very crucial for most of the startups. Funding has been drying up, may not be so in the very early stages, but then the late stage definitely, and maybe the early stage as well, it might come so soon. So we've been insisting on our own startups and even the startups that we are looking at investing in to definitely look at their cash flows, keep the burn to minimum as much as they said as possible, and also keep innovating on how do you keep increasing your growth at the minimum burn that you could probably achieve, while obviously keeping all the other factors intact. So on the break-even side, there is no specific point that you have to achieve a break-even point in certain specific revenue threshold, or to once you achieve after one of our investments. But definitely keep in mind that the funding, if it is kind of drying up, you have to have a runway which is at least a 12-month, and then that way keep innovating, and based on that keep having your cash flow intact, and obviously the minimum churn.
Thank you, sir. Sir, request to hold the mic closer to the mouth so that it is
Sure.
much more louder.
So
Coming to the second question, what is a low-hanging fruit for you in terms of business strategy, such as adopting a platform-based strategy that will allow for a rapid growth, or a startup that focuses on low cost for differentiation? What would you prefer?
So for us, we have done more platform plays of late. That is something that we loved, and we have done quite a lot of that. But obviously there is no strategy specific to having platform plays. E-commerce we love the SaaS businesses, we love D2C, we do quite a lot on the other platform plays as well. But so let's say if there is a fitment for a particular startup to be into a platform play, definitely that's a play that we would be involved in. And whereas say we've been different sectors across spaces, so there is no specific preference, but platform plays is something that we have done more often than the others, and that's where we have in the past couple of months have looked at more and more startups, looking at even doing more as well. But obviously the other piece which you kind of talked about, the low cost and the innovation around that, is something that probably doesn't work for us. we have looked at a couple of enterprise spaces where startups have been innovating on lowering the cost from, let's say, the main players. And I think in the long run, it kind of doesn't work out really well. So we have stayed away from those kind of investments, but definitely on the platform side and the other places on the innovation side, we have invested as well as looking forward for.
Thank you. Next, we have Mr. Dinesh Goel. He's partner SianaCapital. So what are the promising startup sectors that angel investors or venture capitalists are seeing in India?
So, Dinesh unfortunately could not be here, so I'm his colleague Varun Kapoor filling in for him. There are a lot of themes that keep emerging, but how many will stand the test of time? Only we'll know in 10 years. But for a fund which is tech and science focused, we continue to back themes which include biotech, bio-life sciences. We continue to look at themes which are enterprise software-led, B2B businesses. But coming to themes, we are seeing a lot of businesses now which are either SaaS-driven or now, you're also seeing businesses which are in the Web3 domain, some in the metaverse domain. But again, how all this pans out, we'll only know with time. In 2011, one of the more prominent VC investors wrote, "Software is eating the world." And last 2 years, none of us can argue more that software really ruled when it comes to either IPOs or the amount of VC funding that software businesses attracted. So some of these themes will withstand the test of time, and we'll continue to see VCP money go in, and even some of these companies going public.
We have a second question for you. What are the prerequisites of startup at nascent stage with a potentially very big idea? How does the investor ecosystem adapt to the challenges of the gap in understanding the practicality of next-gen technology metrics? Because it's often seen that people who manage money probably don't have enough technological insight to understand it correctly. So how do venture capitalists or angel investors address this gap and then meet the requirement?
So first part of the question, when we typically look at an opportunity, a lot of us VC investors end up backing the team. So the founding team is of very high relevance. We also look at, if you've not made a sale, but how big is the total addressable market or the market that you're catering to. There's also a focus on whether the product is a domestic product or it has international use case, because typically investors like to mitigate risk, mitigate market product risk. So international markets, if you're catering to, is a definite advantage. Then the complementarity, in the team. So typically, when you look at early stage startups, there is too much focus on product. So if they have somebody who's on the business side, is a definite advantage. If they have someone who understands operations better, again, is something that adds to the team. So from a fund perspective, we definitely look at these aspects. Second, I think at least us as a fund, we are cognizant of the fact that founders are smarter folks. So VCs will have their own, we take our own time to understand the technology piece of it. There is a lot of knowledge asymmetry which sits in this industry. So it is a given that there will be things that we will only understand while being a part of that journey. So, working with them, and then you identify certain things, certain areas where you can contribute more. But I think if the opportunity is large, if you're backing the large team, they will somehow or the other find a way to make it work. So I think more than knowing the tech, which is very important, but backing the right team, backing the right product with a large market I think should be good enough. If you have to check 3 boxes out of 4, I would check these 3 rather than do all 4.
So what you essentially said is stick to the Occam's theory. If you're true, you can be simple, and if you're simple, I understand. And people with money are smart enough to not let go their opportunity. Thank you. So that takes us to the last panelist. He's Vice President at Karnataka Digital Economy Mission. We have Siddhartha Anand. And the first question is, what are the challenges in fundraising? Does schemes offered for startups reach the right segment? What has been the experience so far?
Thank you, sir.
But like it is a model which requires heavy investment at first. Like we need to purchase a machinery which is very capital intensive, and we would want to know like would any one of you would be interested in that? Thank you.
So whom do you want the question to be answered?
It is addressed to everyone.
Okay. So would any one of you be interested in funding a capital-intensive at-home dental surgery service? Very high capital-intensive doorstep dental surgery service.
It is not a very high capital intensive. It is a mediocre level. While we like
You said high, so now it is mediocre. Okay, he's reduced the costs down. Vikram,
Why not?
you will. So you can take your business plan to him, tick his boxes, probably you'll get his money. Ashwin.
Yeah, we evaluated one company about 4 years back, which was doing this. So the key here is there are multiple friction points apart from that upfront capex. How are you solving that? Are you solving it well? What have you demonstrated? I think we'll look at all the standard things. I assume you've done it. I'll just give a quick answer so you don't come back. But since we've looked at somebody who's done it in the past, we'll also want to see how you're differentiated and executing.
Deepak, I saw you nodding, so should I even ask you this question?
Now, for our early check side, it kind of doesn't fit. So that's where I think this would, I mean, as a large part of the round, we could probably come in, but still, I think this something that probably won't resonate with us.
You're not getting Deepak's money for sure. And Varun, Sana would be interested?
So for us, differentiation is important, and the business has to be disruptive enough. So these are 2 things that we definitely look at.
So if you make him more money, he'll give you his money.
So
as
our
simple as
unit
that.
are the patented mobile units. Like we have done an innovation. And
No, you can do the pitching later. Please don't do it now.
I was just
Thank you so much. Anyone, last question for the day?
Hi, my name is Avinash. I represent a company called Global Talent Exchange. We've spoken about deep tech, technology, and stuff. So amongst your portfolio companies, how do you go about, ensuring that there's enough talent? There's huge gap when it comes to emerging technology in India. So how do you ensure that, you're getting right talent amongst your portfolio companies?
And who is this question addressed to?
Everybody. Any of them.
So, Ashwin.
Yeah, audible now? Yeah. No, that's a good question. How do we ensure? We can't ensure, right? And we try. We have a lot of folks who keep pitching to us saying we'll help with your portfolio and help on A, talent acquisition, B, talent retention activities. And there are many of them which are AI-enabled, tech-enabled that pitch to us as well. The unfortunate part is if I were to think of the last 6 months specifically, the issue has been extremely acute, as all of y'all will know. How do we help as investors? We typically come in and try and bring in senior talent, which is a founder level -1 talent through our networks, and also sort of be a part of the evaluation process. When it comes to recruitment and talent acquisition, there are some agencies we know who have worked well with certain portfolio companies, which we can then suggest to others to use. But very often the nature is such that sometimes the fungibility is limited. But these are the two ways that we really help. And I think this is the biggest challenge that today a founder faces. And I have heard a company which recently became a unicorn, the founder telling me maybe 2 years back that, listen, I am spending now 70% of my time after my Series A round on A, acquiring talent, and B, keeping that talent. And I think because she did that is one of the reasons they became a unicorn 3 years later. But it's a big problem if you have something unique that solves it, and I assume that's where the question is coming from. I would urge you to look at what else is available and the pitches we keep hearing from folks like you. And if there's something differentiated, we'd be happy to share it with our portfolio companies.
Thank you, Ashwin. Thank you, one and all. We can keep asking the whole evening. It's about money at the end of the day, isn't it? Thank you, one and all, for your patient listening. These woods were wonderful. These woods made you stop in your journey. But as John Frost said, the woods are lovely, dark and deep, and there are miles to go before I sleep. Many promises to keep. There's a long, long night ahead before the day breaks in. Thank you, one and all. Thank you for your support.